Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I'm Paul Winkler. Along with Evan Barner hanging out with me today in the studio.
Howdy.
Man, good to have you here.
Yeah.
This is, so I always say it's good to be had. No, that's not right.
Well, I sure can't work on the property or the garden or anything, so
No.
glad I've got something to do.
I mean, thankfully, it's, how long do we go without rain? I mean, good grief.
Yeah, it's welcome. It's welcome.
That was a long, long time. So yeah, had a blast yesterday with Matt Murphy going on before the debate. You know, just talking about why does he always have to give me hard questions? Because I just knew
He knows you can answer them.
Well, I just knew it'd be one of those things that would be so controversial. You know, it's the whole idea. We got to shut the Fed down. We need to, take that and tear that non-constitutional institution out and throw it to the garbage. It's you hear the kind of debate all the time, regarding the Federal Reserve, and it's just it was set up in the middle of the night, and it's not constitutional, and it's problematic. It's they make all kinds of mistakes and all of these things, and people. A lot of times they don't know much about the history back in the 1800s where you had these bank runs going on all the time. And I talked about J.P. Morgan, called to bail out the banks all the time. It was financial crisis where just absolutely every few years we would have these runs. And you go, well, what does the Fed do? And I said, It's a Wonderful Life was a really good illustration of what happens when you have people that panic about the banking system and velocity of money, and you have so much money that is in the bank, but very, very little of it because of the velocity of money. Money has a turn of 8 to 10 times. So your money's not there. It's in Joe's house, as Matt and I were talking about. It's not where it is. It's not sitting in the vault someplace.
And at this point, it's in the car going down the road and the education expense that was from 3 years ago.
Right. No, that's exactly true. It's exactly true. And, the idea of auditing Fed, I said, well, there's an independent auditor. A lot of people, you don't hear that in the debate, that there are independent audits of the Fed already. And they have they have their own little arm as well inside, and that's another layer. But the thing that always makes me nervous is any time that you have Congress, you have the president, you have anybody, and Matt and I talked about that off air afterward. He says, I don't think Trump's going to do anything, and I go, I agree. I don't think that he's going to do anything either. That he's going to try to take over the Fed or anything like that. There was an article about Brent Ahrens from Wall Street Journal was actually talking about, watch out, retirees. President Trump doesn't understand interest rates. He probably does. Really.
Most real estate people have a pretty good handle on interest rates.
Yeah, and he's making the point that the Fed doesn't control long-term interest rates. And it's interesting, there isn't a direct, that's true. There's confidence that is created through short-term interest rates in terms of what happens with long-term interest rates. But, there is all this talk that the federal government, and there is reason to be nervous about anybody in Congress, anybody in, the government in general getting control over the Federal Reserve just simply because they'll use it for their own political purposes. If there's anything that I was a student of when I was in college, economics and back in high school, what always intrigued me is how could you get a country to go down a path like Germany went down?
Yeah.
Or how do you get a country to go down the path that Russia went down? How do you get a country to go down the path that China, of course, has gone down? And of course, I brought up Venezuela, Argentina, because I basically said, it was funny. I didn't have to bring it up, but I actually had done a little bit of research when I was, just before the show, and I wanted to just look because I don't like to ask questions that I don't know the answers to, right? And
it's like any good attorney.
Pretty much. But what I did is I said to Matt, I says, well, can you name me a country that doesn't have a central bank? And he's like, no. I'm like, right, because it's like Andorra and Kiribati. I don't even know how to pronounce the name of half of these countries. Marshall Islands, of course, I can do that. Micronesia, Monaco, Nauru, Palau, Tuvalu. And it's funny. Who are they? I mean, who are these countries that don't have central banks?
They're not even in the emerging market fund.
No, exactly. And then the other thing that I did is I wanted to look up countries that actually had central banks where there was a lot of government influence. And of course, the ones that come up is Argentina and, as Russia, I think was one of them. China was another one, that I brought up in the interview. And I couldn't think of the Panic of 1907 is what it was. It came to me afterward. But it was the Panic of 1907 that led to the Federal Reserve being something because, they would turn to J.P. Morgan. He would go, hey, I'm not coming to Washington to talk to you fellas. You're going to come talk to me in New York, and I'll talk to you about bailing the banks out. And you go and say, well, what did they have to do? Well, of course, the Federal Reserve controls, you have the reserve requirements and those types of things. But, if you have a reserve requirement that isn't met, the Federal Reserve is the lender of last resort. That is who you actually turn to in order to make sure that you have your reserves that they're showing there, because you don't want to have a situation where you have panics where people pull their money out of the bank, and of course the money isn't in the bank, as we established. So it was a lot of fun, just getting into that. It was a little bit of nerd territory, which always makes me a little bit nervous because Matt asks really good questions. And I'm like, am I going to know the answer to these things? Thankfully, it hasn't turned out where I didn't know what the area, because it's something I study a lot. But anyway, there was something that we heard. We were listening in on a question that was asked regarding Social Security. And I thought I would just address it really quick at the beginning of the show here. Social Security, people often retire early and they wonder what the penalties are. You've got, of course, the penalties if you retire and you decide, or you don't retire, technically you continue to work, 62 to your full retirement age for Social Security. For a lot of people out there, post-1960, people that are born 1960 and after is age 67. Woohoo! And before that, you have the gradual move from 66 to 67, 2 month increments for, when you were born in 1959 or 1958, and you go back 59, you got 68 and 10 months, and if it's 58, it's 68 and 8 months, and it's like and then you go back to 1957, it's going to be 6 months. Yeah, exactly. You go back 2 month increments going backwards. And the thing is that if you retire before that, you have that penalty of $1 for every $2 you earn over the threshold, which is close to $22,000 right now. Now, what happens is that they will recalculate your Social Security. If you actually do have that penalty, they'll recalculate it as if you're older. So if you actually paid 2 years of income or Social Security benefits back, let's say, because of the penalty, they will act like you're 2 years older than you are when you actually get your Social Security back when you hit your full retirement age. Let's say that you end up with a penalty and you don't get your Social Security benefit in the last couple of years, just to keep it really simple. And they've taken away all of your Social Security benefit back. They will actually increase your age, which increases your benefit amount. So that's how that Social Security works. They'll actually give you that money back. It's not the end of the world. Now, what can be a problem, and this is financial planning perspective, the thing that you have to be really, really conscious about is you can look at it and say, do I take it early? Do I take it later? And I am not a hard and fast rule person. Do you take benefits early? Do you take it later? There are a lot of mitigating circumstances as to whether you do that or not. But, that is something when you're in the planning process, you're going, okay, how much of my benefit is, how much am I going to be dependent upon? Am I more security related? Do I want to make sure that I have a benefit that is cost of living protected. Some people try to take their Social Security benefit early because they say, hey, the benefits are going to go away because of the trust fund. And I say, well, what happens is if you take it early or if you take it later, the likelihood is, and this hasn't been actually spoken about other than informally, I've heard it talked about a lot in political circles, that they would just do a pro rata increase. If you took it early, your benefit's going to go down. If you took it later, your benefit's going to go down. So you're not beating the system by taking it early. You're not going to get out of, where the reduction of 20% could happen with your Social Security benefits, because that's what happens if the trust fund goes dry. You could actually have about a 20% decrease in the benefits. Now, the situation is this. Let's say that I am looking at this and going, I'm continuing to work. Like this guy was asking a question, if I continue to work, am I going to get more benefits as a result of that? Maybe. The whole idea is that they look at 35 years of income and they bring it up to today's dollars. So the cost of living increases. So whatever your income was 35 years ago, let's say it's $10,000. And let's say that in today's dollars, that's like 40,000 is today. I'm just throwing out a number. It's not going to be exactly that, but it's like that. If you look at the purchasing power of $10,000 40 years ago, well, it takes a lot more money to live right now. It might take 40 to live right now. So they'll take it up to today's dollars. If you're earning income that isn't any higher than any year in your previous 35 years of data that was looked at, it's not going to increase your benefit at all. So that doesn't really help you at all as far as your future benefits. But I actually had a person recently. They were continuing to work and they were receiving Social Security, as a matter of fact. And this person I recall was like, Evan, I think she was 67 or something like that, 68 years old. Uh-huh. And and she knew it. She was well aware that her benefit was going up as a result of her continued work because she was replacing lower income years.
Yeah.
So that can happen. That absolutely can happen, that it helps. The way to figure out whether that will help or not, there is a neat little calculator on SSA.gov. And you can actually plug in income in future years to determine whether continuing to work will actually increase your benefits. So that's out there. It's a little bit hard to understand how to work with it, and it may be one of those things you go, Evan, Paul, you guys do it. Help me out here. This is not my thing. It's not my wheelhouse. And that's okay. But I just want you to be aware that it's out there. Be aware that it is not a given that your Social Security benefit will go up due to you continuing to work. I know it stinks that you still have to pay Social Security taxes on income even after you're receiving your benefits. I know that's terrible. You're right. I mean, right.
It's like the tax-free tips. You're still paying Social Security on all that stuff.
Yeah. And, so it's one of those things to just be aware that there are tools out there. And it's kind of cool because, sometimes what happens when people project their Social Security, Social Security is going to assume that for example, your current income is going to be what it is going forward. And you may be sitting there going, hey, well, if I retire right now, here's what my benefit will be at age 67. Maybe, maybe not. Because if you go and retire, it depends what the numbers, because they're assuming that your income right now, let's say you're working right now at your age 61 and you're working right now and you're earning a decent income and you're looking at your Social Security benefit statement. And it says at 67, your benefit is going to be $2,700, whatever. Well, what'll happen is if you do stop working and the system is actually assuming that you're going to continue to work, that's when they're doing their estimates. It's assuming that you're going to continue to work. Your benefit could go down because maybe your benefits going forward from age 61 to age 67 would be such that it would have increased your benefits in the future at 67. So you got to recognize what the assumptions are in the Social Security calculators that are online. And if you don't know what they are, it can throw you a loop because you go, oh, wait a minute, I went and retired and then my benefit went down. Why? Because, they were thinking when they gave you your estimate that your benefit was going to be a lot higher because of continued work. So just recognize it's not that cut and dried. You really have to understand the system. It's probably, Evan, I think probably one of the most complicated, convoluted courses I had ever taken in financial planning was understanding Social Security.
I mean, I've even taken courses on like being a registered Social Security advisor or something.
Oh, did you? Did you do that one too?
Some stuff. Yeah. And, it's interesting. You mentioned earlier, not just the math of, did I replace a year in the 35 that was below, average and so forth. Mm-hmm. But you did mention, the factors. And so, we have that conversation with clients all the time.
The break points you're talking about?
No, just the fact of, should I take it early? Should I take it later?
I gotcha. Okay.
Well, no one in my family has made it past 74.
Sure.
Okay, well, that's a factor.
Yeah.
Everybody lives to 100. Okay, that's a different factor too. And so, you look at a lot of things, and sometimes there really isn't a choice to be made. Mm-hmm. Hey, my lights are going to go off if I don't take Social Security.
Right. Exactly.
I mean, the decision is made for you.
Or my back is in such bad shape, I've got to retire.
Yeah.
And I don't have enough in savings.
But there's a lot more factors than just, there's 2,400 ways to take your Social Security. There's a lot to it that is behavioral, life situation, math, do I have children or not? So I'm not worried about leaving assets to the next generation.
Yeah, what's your benefit versus a spouse's?
Yeah.
The higher income earning spouse, that the survivor is going to get that benefit. So it's another thing to think about.
And if any of us were God, Social Security planning would certainly be much easier. But, unfortunately, none of us are. And so you kind of go with the odds.
Yeah, we live in an imperfect world. And then the other thing that people get confused about is the break-even point, because they misdo the math. And the math can be really, really hard to do because of actuarial tables, because of interest rate assumptions and those types of things. But a lot of times the break-even point, because let's say you take your benefit early. Well, you're taking a lower benefit for life. You don't get a do-over. You get a 1-year do-over, regarding that. If you took your benefit and all of a sudden you recognize, maybe it was a mistake, you can actually go and repay those benefits and redo it, as long as it's within 1 year. It used to be you could do that up to age 70, and that was abused. It was really funny when people did it. They take their benefit at 62, and age 70, and they go, you know what? I think it would really be better to have a high benefit level that I should have had I waited to age 70. And they pay all their benefits back from 62 to 70. You used to be able to do that. Isn't that crazy?
That's a big chunk.
It was a big chunk, but there were people that did it because they had the savings. I'd seen people do it. But what happens is that you don't have that do-over again. And then when you're calculating, okay, I'm taking a lower benefit for life versus what if I actually wait to age 70 and I get a much, much higher benefit, because your benefit increases by about 7%. I'm just going to do rounding. It's about 7. It's 5% then it's about 7%. Then it goes to about 8%, in the last 3 years. But your benefit increases each year that you wait on Social Security. So what happens, your benefit ends up being much higher at age 70 than it is if you take it at age 62. Now, the question is, how many years do I have to receive a benefit, the higher benefit at age 70, and that higher amount that I'm getting to make up for the fact that I didn't receive benefits between 62 and 70? And that's when people are doing the calculation on break even. And typically that number is in the neighborhood of 8, 9, 10 years, somewhere in that neighborhood.
Yeah,
it just really depends.
Yeah,
it really depends on the person. But usually around that neighborhood. So you look at it and go, hey, what's life expectancy and those types of things and all of the other mitigating factors that Evan and I were just talking about. So it's not that easy, but there is there's a lot of the more sophisticated financial planning, not some of these more simplistic Social Security calculators, but there are a lot of ones that integrate with the other finances in your plan. And you can make those decisions a lot better if you know that type of information. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. So we have, let's see. Oh, you know what? You know what might be fun, Evan?
Yeah.
Trump promised no tax on Social Security in his One Big Beautiful Bill Act. This Democratic bill could actually do it.
Oh, there we go.
Hey, what do you think about that? So, yeah, what we have here is, okay, so the Big Beautiful Bill, we had that $6,000 a piece, right? The increase in the standard deduction, so you basically have the standard deduction went up to $31,000 and some change. And, you also had another $6,000 a piece, over 65, Evan? Wasn't it for over 65 to $6,000 extra?
6,000 and 12,000, yeah.
Yeah, that's what I was thinking.
Yep.
But it was 65, right?
Yes.
It's just like so many different numbers in my head. Sometimes I just go, God, take me away. So you had that extra 6,000. And, the idea being that we couldn't quite get Social Security. And the reason I proposed that we couldn't get the Social Security taxation taken away was because the system's in trouble already, the trust fund. So the idea being that you have payroll taxes that come out 6.2% on the employer side and on the employee side. And that is how we fund Social Security. If the trust fund runs out, in other words, the extra money that was taken in by the Social Security Administration, the trust fund, that wasn't needed right away because you didn't have enough people that were actually on Social Security. Because of that, because there was all that extra money, he had a surplus fund. Now they're spending that down, and literally at the point where just not enough money coming in. So they have to actually reduce the benefits, in the future. And that's what they're proposing around, 2034, somewhere in that neighborhood. Now, the situation is that you could increase the payroll taxes. That's one of the ideas to do something like that. You could actually decrease the COLA, which is based on labor inflation rates versus the regular CPI. And there are a lot of things that you could do to actually fix that particular situation. Now, what Trump was doing is saying, hey, let's do this. Let's take taxation off of Social Security. Because forever we had these thresholds of 25,000, 34,000, 32,000, 44,000. And the idea being that if your incomes exceeded those numbers, anywhere from 50 to 85% of your Social Security becomes taxable. It's not taken away. It just becomes taxable. Now, the Big Beautiful Bill, the idea was going to be to have some kind of a reduction in taxes or get rid of the taxes on Social Security, but that got torn up. Because if you take away the taxes on Social Security, you take away one of the things that was helping make sure that we had funding for Social Security. Now, the system went under like a 1 year or 2 years earlier if you went and took away the taxes. It wasn't the end of the world, but it got demagogued pretty well in the media, and that ended up going by the wayside. So what happens is you have Democrats come out with this new act that they're talking about, new proposal from an Arizona Democrat. It's called, I love the name of it. I mean, this is like really, this is marketing.
I can't wait to hear the acronym. This is news to me.
Oh, it's not an acronym. It's just you earned it, you keep it act.
Oh, there you go.
I mean, yeah, you earned it, you keep it, Social Security. And, who wouldn't like that? The idea that you've already taken this is tax money, you have this money, and, never mind that Social Security is, a glorified Ponzi scheme where you take money out of one person's paycheck and you give it to another. But, that it's basically billed as a as an investment fund, that money is being put aside for your future. That's the way it's been sold forever.
Yeah.
Even though that wasn't necessarily what was going on. So anyway, they said this would eliminate taxes on Social Security benefits entirely. The bill, introduced in the Senate on Thursday, follows the House of Representatives version from another Minnesota Democrat and a New Jersey Republican. The bill would eliminate taxes on Social Security, called the No Taxes on Social Security Act. Like a lot of Americans, I've been paying into Social Security since my first job at 14, but despite decades of paying into the system, seniors are still forced to pay taxes on their hard-earned benefits. And a lot of people, they do. They bristle at that whole idea. Now, how are they going to do it is my question.
Right.
Well, it says the bill expands Social Security payroll tax to cover earnings above $250,000 a year.
Jeez.
Yeah.
I mean, like, so are they going to leave a gap between whatever the current is, 156 and 250?
Yeah, the donut hole thing. I think that's what they're saying.
They're going to restart it above 250?
Yeah, Evan, I think that's exactly what it is. That donut hole idea that they've talked about is to do it that way. That's as best I can gather from the article. Wasn't really totally clear about that, but that's probably what they're looking at doing right there, something like that. Because, the idea being that people that have higher incomes, they don't vote or they don't have the voting power that lower income people do.
Right.
Now, the problem that you run into is you take these payroll taxes, you look at another 6.2% and on both sides for a lot of self-employed people. You throw another 12% tax on top of, income taxes that are, 40%, right?
Yeah.
And when you get at what point do you go, that's probably enough where, and I don't know about you, man, but I have clients that are like going, I'm taking my toys and I'm headed over to another country when I retire.
We have that conversation more frequently than in the last 10 years.
Do you?
Yeah.
Yeah, I think it's interesting. And I've had some, head down south, not to Mexico, but, to...
Well, we've got clients in Panama now.
Yeah, I was just thinking Panama, that area. I've had some people talk about that. And
it's beautiful.
Yeah. Well,
the dollar goes a long way.
I had one. His wife was I forgot what country she was from. She was Far East, and she grew up in a country. Then he was like, "I'm fine if we go there. I'm okay going there."
Yeah.
And you have some people that just say, "Hey, this is how much further my money can go if I go to." The big thing that has been talked about a lot in the media recently is the level of healthcare in other countries. People getting dental work down in Mexico, and it's hit and miss. But some of it is really, really high quality. You have some people that have been doing that, getting different types of operations.
Medical tourism, yeah.
Yeah, it is a big thing. Hair transplants over in where is it? I can't. I should be able to remember this.
Hair transplants. Wow.
Not because I've been personally thinking about it, but I've had people that have actually asked me about it.
Yeah, I do. Yeah. I do wear hats now when I mow the grass.
There you go.
But when you were doing the tagline of the bill, the "You earned it, you keep it."
Yeah.
It's interesting that the Democrats view Social Security that way, and yet if you're making over $250,000, you earn it, you keep it, just kind of flies out the window.
Oh, Evan, that's exactly what went through my mind. we think way too much alike.
This isn't working. Like
that's exactly what went through my mind.
How's that working for you?
Yeah. Yeah, exactly. It's the same exact thing. It's you earned it, you keep it. Well, wait a minute. Doesn't that apply to everybody? Right. No, apparently not. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.